Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Jay Scott. Now, a lot of you have probably heard of Jay Scott, and he is a big contributor to Bigger Pockets, and he has written many books about the real estate business and industry and negotiating, and he is an expert in many facets of real estate. I'm so pleased to have him as a guest on the show. He's someone that I know I enjoy learning a lot from. He just shares today. Let me back up. He built an amazing single-family rental business and flipping business. He wrote the book on flipping houses. But recently he has transitioned into multifamily syndication. And so I encourage you to think about that and listen to this show, who he is. He's an entrepreneur, an investor, an advisor. Over the past 12 years, he's bought, rehab, sold, lended, and held over $70 million in properties. He has an advisory role in numerous companies. I know you are going to enjoy the show. He goes in depth in what he feels is happening in the economy, what he expects over the next 6 to 12 months as well. Jay, welcome to the show. I've seen you around for a few years now. Jay and I were joking before the show. I said it took me over 1,000 shows to get him on the show. He's well known in our industry and it's in real estate, just expert in many facets of real estate. So, Jay, pleasure to have you on. Give us a little more, though, maybe about your path to where you're at now in the syndication business, and then I want to dive in there a little bit.
Absolutely. And thanks for having me, Whitney. I've been a big fan of your show for a long time. I've been following you for a long time as well. So thank you. So I started in real estate back in 2008. I was a tech corporate guy for a long time. I did the mergers and acquisition and some product stuff for some big companies like Microsoft and eBay. And 2008, my wife and I decided to get married. We didn't want to work the 150-hour weeks anymore in the tech world out in Silicon Valley. So we left the tech world, we left the corporate world, we kind of fell into real estate. I've talked about my story a number of times, so I won't rehash it here, but we just kind of accidentally fell into real estate and we fell into single family flipping. Over the next 10 years through pretty much 2016, 17, we did pretty much everything in the single family world. We did new construction, we did flipping, we did rentals, we did notes, lending, a little bit of this, a little bit of that. Back in about 2018, for various reasons, which I'm happy to talk about, decided to switch my focus to multifamily. And so there was somebody in the multifamily world, a woman named Ashley Wilson, who I had been friends with for several years. She and her husband were doing a lot of multifamily investing. And I basically, since I knew her well and she seemed to be killing it, I asked her if she would help me out, teach me the business and kind of show me the ropes. She was very kind, took me under her wing for about 2 years now. She's been teaching me the business and we've started doing deals together and we've now officially partnered looking to grow and scale the business. So I'm relatively new to multifamily, only about 2 years now. We have basically took down our first deal last year and hopefully pretty close to our second one now. But she has about 800 units. I have 150 units and just looking to make my mark in multifamily, hopefully like I was able to do in single family with a lot of hard work and a lot of study and taking my lumps.
No, that's awesome. I appreciate you elaborating there. But in case the listener, hasn't heard of Jay, which they probably have, I hope they have anyway. Jay built an amazing business around single family homes, wrote the book on flipping houses. Just an expert, no doubt about it, built an amazing business there. So Jay, would you just elaborate some or let's discuss why move from that business model in real estate, something you had obviously spent many years on and very successful at, to moving into the syndication business now?
Well, I'll be honest, the very first reason and probably the biggest reason I started thinking about multifamily was after 10 years in single family, I had amassed some cash. And I was looking to deploy that cash. And it was very difficult in the single family world back in 2018, as it is now, to deploy large amounts of cash. It's hard to find deals. And so I sat down in 2018. I said, I've got this cash. real estate is my preferred vehicle for investment. I know real estate. I understand real estate. Nothing against the stock market, but I'm just not a stock market guy. I like the control over my investments. I invested with a couple syndicators, operators as an LP, a limited partner, and nothing wrong with that. I enjoy that, but I'm a control freak. So I said to myself, how can I deploy large amounts of capital where I actually have control? And what I realized was operating syndications myself would allow me, one, to maintain the control, but putting money in on the LP side as a GP would also allow me to deploy my capital. So I originally considered getting into multifamily. And the reason I originally got into multifamily was because I was looking for a place to put my own capital. So that was how it started. Then I started looking at just the economic indicators. Did I think multifamily was poised to do well over the next few years? Obviously, multifamily did well between 2012, 13, 14, and that point, 2018. And at the time, I don't want to say that I was skeptical, but I was on the fence. And I said, look, I'm going to give this a year or two. I'm going to track the economic indicators. I'm going to look at the data, and I'm going to see if I really think that that multifamily is poised to do well over the next 5 to 10 years, because that's typical duration of these projects. I was hoping if I can pick up a 4 or 5 or 10 projects over the next couple of years, I'd be in the space for 5 to 10 years. So I started tracking the data. Obviously, then COVID came along. And COVID kind of changed everything. And so I kind of had to do a reset last year, probably right around this time. And what I realized is that regardless of where I thought multifamily might be headed a year or two ago, I'm now very, very confident that multifamily is a great asset class, a great vehicle to be investing in right now. And there are a number of reasons for that. First of all, you just look at interest rates. Interest rates are at historic lows. A lot of people think interest rates may be going up over the next few years. If you, the Fed just announced, we're recording this in late June. The Fed just announced a couple of days ago that they think we'll probably see 1.25 point rise in interest rates over the next 2 to 3 years by the end of 2024. If you're a multifamily person, you're probably thinking, that's not really good for us. But think about why interest rates go up. Typically, the Fed raises interest rates to curtail inflation. When we have inflation, when the price of things are going up, the Fed's going to raise interest rates, just going to kind of slow the economy down. Well, that means if the Fed's raising interest rates, that means we likely have inflation. So what does that mean for us as multifamily investors? Well, if we have inflation, that probably means that, big thing, rents are likely going up. So if rents are going up more than the average, that can often offset the increase in cap rates. That can offset the increase in interest rates. We see asset values going up, so we'll probably see compressed cap rates. So yeah, I know the biggest thing people talk about in multifamily right now is what happens if interest rates rise. But to me, that's a good indicator, because that means we have inflation. And that means we're going to make up the loss from higher interest rates in other areas due to inflation, rent and asset and compressed cap rates. And the other thing is, I've always been a tremendously conservative investor. I won't do a ton of deals. But from my perspective, if you underwrite deals more conservatively, if you think interest rates are going up, if you think cap rates are going to expand a little bit, be more conservative in your underwriting. Instead of assuming 10 basis point increase in cap rates every year, assume 15 basis point increase in cap rates every year. If you're conservative, you're going to find deals and you're going to do well. Personally, I just really like multifamily. The other thing is, there's been talk over the last few weeks of a 5 million unit housing shortage in the US. So everybody's wondering why housing is doing so well. Well, we haven't built much since 2008. There's been underdevelopment since 2008. So there's a shortage of housing units. And so multifamily is a pretty safe place these days. Well, where do investors flee when they start to get concerned about interest rates or inflation or other asset classes? They flee to safety. So investors are going to flee to multifamily. And when investors flee to multifamily, we're likely to see more cap rate compression. We're likely to see higher growth. So all in all, I just think multifamily is a pretty safe place to be over the next 5 to 10 years. I don't have a crystal ball, but all signs point to multifamily being a great vehicle.
No, I appreciate you elaborating on all those points there, and just, single family to multifamily. And I just think you can speak to that individual that says, I can just go over here and do my own thing in single family and do just as good. But I would like to ask you that question, and then I'd love to move on to, just more about what you see in the economy and interest rates. Some of that, I think that's a very popular topic and things people are wanting to know about. Well, I get the question often, it's like, well, Whitney, why wouldn't I just go do my own thing over here in single family? I think I can, just keep buying enough single family homes. Why would I invest in syndication instead of doing that? I just wanted your thoughts around that, because I'm sure you get that question also.
Yeah, for me, it's economies of scale. Nothing wrong with single family. I like single family. I still invest in single family. I own dozens of single family rentals. I'm buying single family now. But for me, I love the economies of scale in multifamily. And I also love the fact that with single family, you're basically you're at the whims of the market. So the values of single family are going to go up and down based on the values of other single family in your area. Whereas with multifamily, you're still at the whims of the market to some extent. You're at the whims of cap rates and you're at the whims of interest rates. But for a large part of the success in multifamily is going to be driven, is going to be driven by your ability to carry out a business plan. Can you raise the income? Can you lower the expenses? Multifamily is much more like a business than single family. Single family is very much an investment, but multifamily is a business. I'm a business guy. The reason I've been good at real estate is not because I know how to swing a hammer or know how to manage contractors. I know how to run a business. And for me, businesses are all the same. Your goal is to get the net operating income or the net income, whatever it is in your asset class, up as high as possible. So you're looking to raise income, you're looking to make things more efficient and lower expenses. And so I feel like I have a lot more control over multifamily because I'm controlling the business plan than I do in single family, where it's essentially buy and then wait for values to go up, hopefully.
No, I love that. No doubt about it. Yeah. I love how you said too, it's more like operating a business. No doubt about it. The more efficient you can operate that business, the more your property's worth ultimately. And so no, that's great. Well, I want to jump into a little more, just any more depth on what you see in the economy. I ask most guests, that are operators, just like, what do you see over the next 6 to 12 months and what are you doing? How's your business changed maybe over the last, year, or just your thoughts around the economy, anything like that?
Yeah, so it's hard. And I don't have a crystal ball, and I don't want anybody to think that anything I say is anything more than just a guess. We're all just guessing. COVID kind of changed the rules when it came to the economy. And to a large extent, where we're living right now is in kind of this fake economy. We still have a lot of shutdowns. We still have supply chain issues. We're seeing inflation, which there's arguments whether it's transitory inflation. Is it going to go away when all the supply chain issues fix themselves? Or is this going to be like the 70s where we see high inflation for the next 5 or 10 years? Nobody really knows. That said, I think what we're likely to see is, this, everybody's referring to it as a K-shaped recovery. We're likely to see that those who are doing well, those who invest in assets, those who invest in cash flow are probably going to do pretty well. Whereas those who are living paycheck to paycheck, those who rely on wage growth, they may struggle, because it's very likely that over the next at least 6 to 12 months, and who knows, maybe much longer, we're likely to see more inflation in the cost of products than we are to see inflation in wages. We're likely to see the cost of living go up. We're likely to see the cost of consumer goods and commodities go up faster than we're likely to see unemployment drop and wages go up. So I think there are going to be a lot of people who are struggling over the next 6 to 12 months, but there are also going to be a lot of people who own things like housing and stocks and businesses and hard assets that are going to keep going up in value. So I think a lot of people in this country are going to do well. A lot of people are going to do poorly. How does that factor into the housing? Well, I think that if we see unemployment kind of not drop further, and if we don't see wages go up, I don't think we're going to have a foreclosure crisis like we saw in 2008. I don't predict anything like 2008. But what we could see is we could see a lot of people moving out of housing, losing their houses, and moving into rental property. I think we could see a lot of people choosing to move into rental property simply because they're simplifying. A lot of people during COVID have realized that that work isn't the end all be all, and they're looking for more of a balanced lifestyle. And for a lot of people, that means living in some place they want to live. That means living in a low income tax state, living in a nice weather state. A lot of people moving down to Texas and Florida. Well, prices are rising in those areas. Housing prices are rising. So a lot of people are moving, but they're not necessarily buying, they're renting. So I could see that the economy could be driving people towards this country becoming a renter nation over the next couple of years. So long story short, I think there are going to be a lot of people who thrive over the next couple of years, especially those who own hard assets. There are going to be a lot of people who struggle until we either see wage growth or we see the inflation slow down. But either way, I think it's going to be good for us as multifamily investors.
Okay. Yeah. I know that's incredible. I just appreciate the level of detail. Even thinking about where it's causing people to move, but then they are moving, but they're becoming renters because of maybe the expense. You mentioned like no wage growth, but like prices of things are going up, but maybe their wages aren't going up. How do you combat that? Say, you're looking at properties, you talked about conservative underwriting, we're trying to predict obviously rent growth, things like that. But if wages aren't going up, what are your thoughts around that?
Well, there's a couple possibilities. One is that inflation is transitory, and in 6 or 12 months, we go back to the way things were before COVID. So prices of things, I'm not going to say they're going to drop, but they're not going to go up nearly as fast as they have been. And maybe wage growth starts to catch up a little bit. That's, I don't want to say the best case scenario, but I think that's one possible scenario. The two big scenarios that people are talking about is that we continue to see inflation. So we continue to see the price of things going up. Now, inflation can kind of go two ways. We can have normal inflation, where not only does the price of commodities and consumer goods and asset go up, but also wages go up and people are doing well, unemployment's going down, the economy is booming. That's typical inflation. But then we have this other type of inflation that's often referred to as stagflation, where we still have the price of consumer goods and commodities and assets going up, but we don't see wage growth and we see unemployment higher than we want it to be. Basically, we get all the bad parts of inflation, the price of everything going up, but we don't get the good parts of inflation, the wage growth and the consumer growth and the economy booming. So a lot of talk these days is, what are we likely to see over the next couple of years? Are we likely to see inflation stopping? Or are we likely to see inflation continuing? And if inflation continues, is it going to be regular inflation or stagflation? So those are kind of the three potential things that we see. I'm going to say I don't think we're going to see inflation slowing down tremendously over the next couple of years. I don't think it's going to be hyperinflation. I don't think things are going to get out of control, but I think we're going to continue to see inflation. So then the question becomes, is it regular inflation where the economy is doing well? Or is it stagflation where we see prices going up and the economy is not doing well? This is where I think the Fed and the federal government come into play. And what are they going to do to combat the potential for stagflation? I'm a big believer that the Fed typically gets what they want. We've seen that over the years. And what we've seen is that the Fed has been pretty aggressive over the last 10 years since the Great Recession at ensuring that the economy kind of stays on track. I'm not saying that the Fed has ultimate control over where things head, but I think they will do everything in their power to avoid stagflation. They'll do everything in their power to avoid too much inflation while keeping the economy on track. So if I had to bet, I would bet that the Fed takes probably ridiculous measures to ensure that at least for the next few years, the economy continues to do well. Even if we have inflation, it's not going to be the type of inflation that hurts consumers. So if I had to bet, I think we're good for the next 5 or 10 years, thanks to what the Fed is likely to do. Now, we go out more than 10 years, well, our economy could be in a lot of trouble. We could be compounding problems over the last 10 years and the next 10 years, to the point where in 10 or 15 years, things could be beyond salvageable. But I think for the next 5 or 10 years, there's enough runway that the Fed, if they do what I think they're going to do, will keep the economy on track, even if it's hurting us long term.
How has, say, your underwriting, from what you know, from what you just said there, how's your underwriting changed, say, over the last year or over the last 6 months even?
Yeah, so a couple things. One, we assume that there's going to be some cap rate expansion in the markets that we're in, and we're in some really highly competitive markets, Houston being one of them. We've seen really, really tight cap rate expansion. I mean, in the B-class inventory that we're investing in, we're seeing cap rates in the 4.6, 4.7% range, which is just crazy. And we're likely to see, I think, interest rates going up, not tremendously, but maybe a point and a quarter over the next 2 or 3 years. So obviously, any assets that we buy today, we're going to be holding for at least 3 to 5 years. So a couple of the things that we're doing. One is we're being very conservative on our exit cap rates. Again, instead of assuming a 10 basis point increase in cap rates or a half point increase over 5 years, we're being more conservative and assuming closer to 15 basis points or closer to 3/4 of a point increase. While we're not being overly aggressive on our rent growth, we do recognize, again, that if we continue to see inflation, and that's going to be what drives cap rates up, and that's going to be what drives interest rates up, we're likely to see greater than average rent growth. So for us, that's going to be a bonus. So we still underwrite to whatever rent growth is being predicted in our markets, but we're hopeful that we'll see increased rent growth over the next couple of years. And we're focusing on those asset classes that we think have the most likelihood of doing well. We're kind of staying away from the A class. I personally love A class, but I think if we see inflation, A class could take a hit. And we're focused kind of squarely in that B class inventory. So where a lot of what we see are typical consumers looking to get into, people that are moving out of homes and moving down into new areas. They're focused on that B-class inventory for the short term while they're trying to figure out, are they going to buy or are they going to be long-term renters? So it's not just underwriting for us, but it's also picking the right areas and the right asset classes. What we're finding is that there are some areas now where it's getting so competitive that we just can't buy at reasonable cap rates. So we're moving into areas that tend to be a little bit less competitive. I'm a big believer. I was a poker player for a long time. And I'm a big believer that one of the most important things in any professional capacity is good game selection, good table selection. I like to say that if you're the 10th best poker player in the world, you're still going to lose a lot of money if you're sitting down with the top 9 poker players in the world. So for me, it's very much choosing those markets that are less competitive, because even if I think I'm good, I'm probably never going to be the best. So I'd rather be playing in markets where I'm the one people are looking at and saying, he's my competition. So we're being very market selective these days, moving into markets that have higher cap rates, that are a little bit less competitive. And so those are the big things that we're doing.
Would that mean maybe markets that maybe you wouldn't have considered a year or 2 years ago? Maybe 100%. A smaller market? Yeah.
Yeah. And the other thing is, a year or 2 years ago, we were ruling out markets that we were concerned didn't have enough recession resistance. One of the big things we look for when choosing a market is, historically, we've looked at what was that market doing back in 2008, because assuming nothing has changed in the economy in that market, assuming there's the same amount of population growth and employment diversity, most likely that market would perform similarly during the next big downturn as it did back in 2008. So a couple of years ago, there were a few markets that we ruled out because we thought maybe there's a recession coming. And we didn't want to be in any markets that didn't have employment diversity, didn't have wage growth, didn't have employment growth. Now we're looking at those same markets and we realize, well, the likelihood for a big downturn anytime in the next couple of years has significantly subsided. And so maybe those are good markets. We wish we would have gone into those markets 2 years ago, but we made the right decision then. But now we're reconsidering those markets. So yeah, we're certainly looking at markets now that we weren't considering a couple of years ago. We're looking at some secondary markets as opposed to primary markets, whereas a couple of years ago, we were mostly focused on the primary markets, and even some tertiary markets that we think could have some major opportunity.
Well, that is awesome. Jay, I appreciate you just elaborating on each of those details. I just think it's great for all of us to hear and how you're thinking about the markets. Definitely an expert, and you've been doing this a while. And so it's great to think about your underwriting, what you're seeing differently, even thinking differently about markets than we did 2 years ago. But just to change gears a little bit, unfortunately, we just have a few minutes left. What are some daily habits, Jay, that you are disciplined about that have helped you achieve success?
Yeah. So the big one is, again, from a business perspective, every day I try and figure out what parts of the business I can do a better job of systematizing, what parts of the business I can do a better job of outsourcing to people who are smarter than I am. In the single family world, we can typically do all these things ourselves. It's not too hard to be a one-man show or one woman show in the single family world. In the multifamily world, multifamily is a team sport. And what I find is a lot of people that try and make the transition from single family to multifamily try and do it all themselves. They want to do the sourcing. They want to do the underwriting. They want to do the due diligence and the contract work. They want to do the fundraising. They want to do the asset management. They want to do the construction management. They want to do everything, because in the single family world, that's what you do. There's not a big enough pie to split up among 4 or 5 or 15 people. In the multifamily world, there's some very specialized tasks. You don't want me running asset management. I think I'm pretty good at business, and I'm good at managing a business plan. But as good as I might be, there are people out there who are the best asset managers in the world. My partner, Ashley Wilson, is the best asset manager I've ever met, barring obviously you and your team. So that's not something that I should be doing. Likewise, on other areas of the business, we're always looking to find the absolute best people and bring them in to help us. And so every day I'm thinking about what part of the business shouldn't I be working on? Not shouldn't I be working on? What part of the business that could be better handled by somebody smarter than I am? What parts of the business can be systematized or processed so that moving forward, I have the time to focus on the things I'm really good at. And so that for me is the biggest thing that I do every day. And I encourage anybody that's looking to scale their business, really focus on how to get the best people in the best seats so that you can focus on the 1 or 2 things that you're really good at, because none of us is good at everything in multifamily.
I could not agree more what you just said, Jay. No doubt about it. It's when I found my business partner, it's like, man, we have a lot in common, but we have complementary skill sets, right? Things that he's really good at and loves. I don't care about working on every day, and then vice versa. And so I could not agree more. You want to scale fast. You need experts that do those things that you despise doing or just not the highest and best use of your time. But what's your best source for meeting new investors right now?
So I guess I'm very fortunate. I've built a little bit of a brand over the last 12 years. So I have an opportunity. If there's somebody I want to get in front of, I probably know somebody who can help me get in front of that person. For me, the biggest thing is I'm an introvert. So I need to get up that motivation to network and meet people. It's not so much how do I meet people, it's getting the motivation. And I know there are a lot of people out there like me who you're in the same. That's the nice thing about the single family world. You can do everything yourself. You don't have to meet people. You don't have to network. In the multifamily world, building relationships is obviously everything, especially if you're sourcing deals, if you're building your team. So for me, it's less of a question of how I'm meeting people and what I'm doing to really force myself to meet people. And for me, that's just a struggle I deal with every day. Every day I have to say to myself, hey, get out there, go on social media, go pick up the phone and call somebody, send a text to somebody that I've been meaning to get in contact with, send an email to somebody that I was in contact with, but I may have lost contact with, build my network. And so for me, that's very much turning into a daily habit. I try and spend an hour a day simply networking. And again, whether that's social media, whether that's sending texts, whether it's sending emails or picking up the phone, I force myself. And a lot of people, this comes naturally. For me, it doesn't. So an hour a day is difficult. But what I found is that it's really helped me over the last couple of years as I've gotten into multifamily to start connecting with the people in the industry that are doing the same thing I'm doing, that are struggling in the same ways I'm struggling, that are learning things for the first time and really sharing best practices. So for me, it's not so much how I'm meeting people, it's just forcing myself to do it and make it a habit.
Yeah, well, that's awesome. That's how you're doing it. I mean, you're forcing yourself an hour a day. I love that you're that focused and strategic and even consistent, right? Thinking about that, hey, an hour a day, and you consider yourself an introvert. I think there's a lot of listeners who can probably relate to that. They feel like they can't, they're scared to put themselves out there. Well, hey, Jay is there and look at your brand and where you're at, and you're pushing yourself to do it an hour a day. What does that hour look like? Give us a little detail there or insight into how you structure that hour to be most effective.
Yeah, so I walk around with my cell phone and I take notes. I have a notepad app on my cell phone. And if I think about it, if somebody pops into my head and I think, oh, I haven't talked to that person in a while, I'll just make a note, contact this person. Or if I have an idea for something I should be focused on, make a note. And I know so many people who have these ideas, they're constantly coming in and then they never take action on it because they don't write them down. I write these things down. And so every day, literally, I'll pick up my phone and I'll say, okay, what are the random thoughts I had yesterday? Okay, this one, that's ridiculous. Get rid of it. This one, oh, was thinking about this person. Instead of thinking about that person for the next 2 weeks, I'm going to send that person a text right now. Or I'm going to pick up the phone and call them right now. It really is. It's just documenting the things that go through my head and then going through like a checklist every day and saying, that's a good idea. That's a bad idea. Go contact that person. So yeah, if I were talking to anybody else, I would just recommend make notes. Keep a list of things that pop into your head, because a lot of times people have really good ideas, but they're fleeting. And if they don't write them down, they'll never do them.
What would you say is the number one thing that's contributed to your success?
Treating my businesses like a business. Not treating my real estate as a hobby, not treating my real estate as necessarily a one-man show, treating everything like a business. I like to think I came from the tech world. I spent much of my career at Microsoft, 80,000 person company. I'm never going to run an 80,000 person company, but that doesn't mean I can't run my real estate business the same way an 80,000 person company is being run, obviously without all the bureaucracy. But in the same way, hiring really smart people to sit in the right roles, the right seats, put in place the right systems and the right processes to really allow me to focus on what it is I'm good at, because I am not good at a lot of things. And that's why in my business, I want to be hyper-focused on those things I'm really good at and have other people around me who can be hyper-focused on all the things I'm not good at because they are.
And Jay, how do you like to give back?
For me, giving back is an everyday thing. I'm not let's do something big here and there. I little things like if I go through a drive-through, I'm always going to pay for the person behind me. If I go through a toll booth, I'm always going to pay for the person behind me. I literally the other night I was at dinner and I saw this woman who I don't know if she was a single mom or not, but she had 3 kids and she was struggling, and so I just called the waitress over and gave her my credit card and said, I want to pay for that person. For me, giving back, certainly there are big things we should be doing, but I don't like to think of giving back as a big thing. I like to think of giving back as something we should be doing every day. If you can make 10 people's lives a little bit happier today, they're going to go out and make 10 people's lives a little bit happier. And they're going to go out and make 10 people's lives a little bit happier. So just do nice little things for people every day, because they're going to pay it forward and they're going to pay it forward and they're going to pay it forward, and the world will become a better place.
Appreciate you sharing that. I love that answer, that it's not just this one big thing, but it's like just having the mindset of giving and caring about others, no matter where you are, whether it's the toll booth or whether it's the restaurant, wherever, there's usually someone that you can pull up a little bit anyway, right? And brighten their day. And like you said, then it goes on and hopefully they're going on to brighten someone else's day. Well, Jay, amazing show. Just grateful to have you on and connect again personally, but also, you for connecting with the listeners as well and just sharing just from your expertise about where you see the economy and interest rates and those things headed, and what you all are doing to be conservative, and how underwriting's changed, and even going from single family to syndication. Just an amazing story. Appreciate you detailing that. I think there's a lot of listeners who will relate to that in a big way. Tell the listeners how they can get in touch with you and learn more about you.
Yeah. So anybody that wants to connect with us, anybody that might want to invest with us or find out more about what's going on with us, www.connectwithjscott.com. That's simple. That'll lead you out to everywhere you need to go.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.